Back to another video. In this video, I'm going to be showing you everything that you need to know about trading using fair value gaps and what fair value gaps are, how to trade with them, how to use them, and ultimately how to use them when you're trading ICT's price action. Because fair value gaps and liquidity are the most important ICT concepts when it comes to trading. So if you can master how to trade using fair value gaps, but not only how to trade with fair value gaps, but just how to utilize and use fair value gaps to your best of your ability, then you will definitely be making a lot more money in the markets. So the first thing that I'm going to explain to you guys is what a fair value gap is. Now, if you don't know what a fair value gap is, all it is an imbalance in the market where price leaves behind orders that need to get filled in the future. So once we create a fair value gap, then the fair value gap will most likely be filled in the future. So how do you spot a fair value gap? If we are looking at the daily chart, now fair value gaps are on all different time frames, but I'm just going to use this daily chart because it is extremely easy to spot them. So when you are looking for a fair value gap, what you want to do is count 3 candles. So it's formed within 3 candles, and the first and the third candle must not connect or touch each other. So if we look right here, and we count 3 candles, so this first candle here, the second candle here, and then this third candle here, as you can see, there is a big area right here from the first candle here and the third candle here where price action has not touched. So that is a fair value gap. Now a lot of you are probably asking, does it have to be a wicks? Does it have to be bodies? Now fair value gaps can form with wicks or bodies, just as long as there is an imbalance, as long as there is a gap where price action is, then it is a fair value gap. So that is one example right there. If you also look down here, we have another fair value gap right here. So if I was you, after this video, and you're unsure with fair value gaps, just go to your charts, look for fair value gaps, mark them out, and yeah, because this is a very, very good well, you need to know what fair value gaps are if you are trading ICT concepts. So that is a bullish example. So what did we do? We count 1 candle here, as you can see, 2 candles there, 3 candles there. Then we find that the first and the third candle have a gap, have an imbalance. So there you can see from this point right here, from there to this point right here, that is called a fair value gap, and some people like to label this as FVG, so the fair value gap. So with lines, you can easily see right here, price has not came into, there are no wicks. If this candle, for example, came into this price action, it doesn't matter. That doesn't make it not a fair value gap anymore. It is still a fair value gap. So yeah. And now the way that you want to use fair value gaps, well, first of all, let me actually show you a bearish candle example. So these are bullish fair value gap examples. When you're looking for bearish fair value gaps, they are exactly the same. You just find 3 candles. So right here, 1, 2, 3. We have our 3 candles right there. And in the middle, as you can see, there is just a gap in the market where price has not filled. And as you can see, this next candle taps into the fair value gap and then carries on going down. Now, you might be wondering, why are fair value gaps important? Now, fair value gaps are like a little magnet of price action. When you see fair value gaps created, you will almost all of the time see price action come back into the fair value gap and either carry on to its direction or just cut through the fair value gap. But most of the time, especially on the lower time frames, the fair value gaps like to get filled. just because it is a little void in the market. So if you look right here, this is not a fair value gap. Do you see how there is this wick here and this wick here overlap? So therefore that is clearly not a fair value gap, so don't get confused. It has to be a clear gap in the market. Just right here there are two wicks, so you cannot draw a fair value gap there, but whereas here there is a fair value gap, 1 2 3, and then right here there is also another fair value gap, bearish fair value gaps. Yeah, so that is one way that you are going to find, that is how you're going to find your fair value gaps. Now, the way you're going to want to use fair value gaps in the market is, let's say we have all these fair value gaps here, and we are zoomed out so we can see the price action better. The main way that I like to use fair value gaps is actually if they are turned into an inverse fair value gap. Now, when price comes into a fair value gap, what most people want price to do is for price action to go into that fair value gap and then tap into that fair value gap and then carry on going in their desired direction. So for example, this fair value gap right here, as you can see, price comes back, has tapped into it, and now price is going up for buy side liquidity. The same with this fair value gap down here. Price is respecting this fair value gap, comes down, taps into the fair value gap, and then pushes straight up. So that is how most people use fair value gaps and want to see fair value gaps used. Whereas with me, when I am trading fair value gaps, I like to wait for them to be inversed. Now, what I mean by that is I like to wait for a close above or below the fair value gap. If it is a bullish fair value gap, then I like to have a close below the fair value gap. If it is a bearish fair value gap, I like to have a close above the fair value gap. Now, if we are using that theory from what I just said on the higher time frame, so let's look at the market. Now, if I was trying to gain my bias, so let's say I'm trading next week and I need to have a bias of if I think price is going to go up or if I think price is going to go down. So the first thing that I would do is I would look to the left. I would mark out all of the bearish fair value gaps. So we have a bearish fair value gap there. We have a bearish fair value gap there. And now I'd see that price is in these fair value gaps. But if we are just looking at this one bearish fair value gap here, do you see how, as I just explained, with fair value gaps, what people want to see, like what's happened over here, people want to see the price tap into these fair value gaps and then for price to keep on moving in the same direction. But what I wait for is a candle close above that fair value gap, which shows me that price then most likely wants to go and take some sort of liquidity in that direction. So as you can see right here, we have had a close above this fair value gap. So here, right here, the fair value gap has been disrespected. Therefore, I then say to myself, oh, I know that price will most likely want to go for this buy side liquidity, which it then took. And then for next week, let's say, my bias for next week, if we break this fair value gap here, so if we get a candle close above this fair value gap right here, then we should go for this high right here. And yeah, that is how I use fair value gaps. Now, let's say, as you can see, price is also respecting this bullish fair value gap. So that is just another reason why I think if price breaks this fair value gap, we are most likely going to go to the upside. And this is also the model that I trade on lower time frames. I trade for free every single day in my Discord. But I just want to keep this video very brief. I just want to explain to you guys that how to recognize fair value gaps. So from this video, I want you to mainly be able to recognize fair value gaps, mark them up on your chart, and then just see if a fair value gap gets violated, see what price action does, or see if the fair value gap respects it, and just see how price reacts to these different things. So yeah, I hope this video was useful. Make sure to join my Discord. Thanks for watching.